Moving from working capital to capital structure, let's talk about what this really means. Capital structure is an organization deciding, making a commitment, making a focused effort in the amount of long-term debt they want to finance the organization over the long run versus equity. And here we want to be clear on a basic point. Even though in most of these conversations we will use the term debt, and you will hear the term debt used around the financial world, we're specifically referring to long-term debt. Because if you go back to the very first module when we talked about the matching principle, we're matching the long-term debt to the equity. We're looking at what is the growth capital of the organization. How much of it do we want to borrow for various reasons, and how much of this do we want to be owner's capital? This is a classic question, and it's a question that's extremely important for a variety of reasons. First of all, debt being borrowed money means we must repay it, and it must be repaid as agreed. So in the previous couple of slides, we were looking at working capital. We were looking at paying our short-term obligations when they were due. Well, now we're looking at long-term debt, which is financing our long-term assets, matching long for long. Long-term debt is designed to be used to finance long-term assets because of a very important concept. Again, it's matching. We financed our current assets with current liabilities because when current assets get converted to cash, we sell our inventory, it becomes a receivable. We collect a receivable, it becomes cash. The first thing we do with that cash is pay our payables. That working capital or liquidity cycle is self-funding. We pay our short-term obligations with our cash flow. Well, now we're talking about capital structure. We repay debt not through cash flow, through profits. That's a very important differentiation. So when we're looking at how much debt to incur in the organization, how much long-term debt, bank debt, bonds, capital leases, are we willing to contract for? We have to look at the projected profits of the organization to make sure there's enough profits to repay this debt. If we use debt properly, we borrow the money, invest it in the company in long-term assets. We use the long-term assets to generate increased revenue, increased profits, use those profits to repay the debt with some margin. That margin, that excess return beyond the cost of the debt, is what increases the value to equity. So how does an organization decide what its capital structure should be or will be? Well, again, it goes to choices. How aggressive do we want to be? The more aggressive an organization is, the higher the debt to equity proportion will be. So why do we want to have, why would we allow ourselves to have more debt than equity? Very simple reason. As we demonstrated in the previous module, debt costs less than equity. Now, I know some of you are thinking that's counterintuitive, but remember, debt, we negotiate the cost of the debt with the bank. In many countries, the cost of the debt, the interest, the return on the debt is an expense on the income statement, which reduces our profit, which reduces our taxes. So in tax-paying countries, debt gives us an advantage over equity because the cash cost of equity is dividends. Dividends are not tax deductible. Interest on debt is, number one. Number two, who expects a higher return, therefore a higher rate, on the capital they provide? Lenders or investors? Well, going back to the conversation in the previous module, equity investors, our shareholders, always take a higher risk in putting capital in our company because they have to wait longer to get a return, whether that's a cash dividend or an increase in the value of the shares. And in the unlikely event of default, of bankruptcy, they're the last ones to get paid. So providers of debt take less risk. Therefore, they require a lower rate of return. Now, some of you are thinking, but wait, some shareholders get no cash dividends. So how can that have a cost? Well, as you'll see later when we calculate our weighted average cost of capital, in finance, in business, we calculate an imputed cost of equity. In other words, we estimate what the marketplace, what our shareholders, what our investors expect in an annual return, either in a cash dividend or in an increase in the value of the shares, the value of the firm, or a combination of those two. And we'll actually go through a model later to calculate that. So if debt takes less risk than equity, debt costs less to us, to the organization, than equity, then probably we want the maximum amount of debt in our organization and the minimum amount of equity. That would be a very aggressive position, and in some cases that would work. But we also have to remember the big picture. For every organization, our capital structure made up of our long-term debt and equity, if the proportion of debt to equity gets too high, then the probability of default, of not being able to meet our debt obligations, starts to increase. And this is why. Every organization projects a certain amount of revenue, cost, and expense, our income statement. If we plan properly, we will meet or exceed those goals. But we all have seen examples in every industry, in every economic time, where there are surprises and an organization does not generate the profits it expected to. Well, although our shareholders are willing in many cases to wait for a return, the bank isn't. We must pay our debts as they're due. We must repay our long-term lenders according to the contract. So the higher the proportion of debt to equity, the more borrowed money over the long term financing our growth, the higher the probability that we won't be able to pay that at some point. Therefore, the lenders begin to increase their required rate of return, the interest rate. As the lenders begin to increase their required rate because of their perceived risk, equity investors begin to do the same. Now our cost of capital begins to raise. So every organization, in every market, in every industry, has to regularly look at the capital structure. How much debt today, moving forward, do we want to have financing our growth compared to our equity? Is the proportion acceptable? Is the debt too high for what's happening in the future as we see the economic cycles, as we see changes in our customers and our markets? Do we have enough equity as our baseline? These are questions that every organization must address on a regular basis because we are in a fluid financial world. So basically, debt is our long-term borrowed money. It costs less than equity. The more debt we have, the lower generally our blended cost is, our weighted average cost of capital. But the more debt we have, the more leverage we have. If we're comfortable with high leverage, we can take a risk. And we'll address that fairly soon.